It is unlikely to be this week. Certainly, markets are not expecting the Fed to do much tomorrow, except, of course, to do some signaling. And that's what we really need to take a close look at. What is in that statement and what Chairman Powell says at the press conference. And I think there are probably three things to be watching for in that statement. One, obviously, the question being, are interest rates going to, are they signaling a hike? Are they signaling a reduction? Or are they signaling that they are going to be staying where they are for the indeterminate future? So clearly the signals on where interest rates are heading will be something to watch for. Something else to watch for, less so in the statement and more in the press conference, will be the FOMC's plans for the balance sheet. You'll recall that there has been a sense of market uncertainty about where the balance sheet is heading, what the pace is in terms of bringing about a more normalization of the balance sheet. So I think that's a second thing to be watching for tomorrow. And the third piece, I think that is more of a long-term nature is, if we have a slowdown, if we have a downturn, how long is it going to last? And are the tools in place to deal with to make sure that any kind of downturn is short-lived? That's, I think, another important piece. Certainly, as we head towards slower growth, as the possibility of a slowdown becomes more real. What's the state of the Fed's tools in terms of making sure that we have a downturn that is a V-shaped one rather than a longer-term L-shaped one? So those would be three things to be looking for.
How much worse do you think the economic outlook has to get from here before they are seriously considering cutting interest rates?
It's a that's a great question, and I think it's going to depend, Sarah, on what indicators are coming in. I think right now they do have their eye on certain measures that are probably less than optimal. They are wanting to make sure that things don't deteriorate further, and they're also watching these headwinds, right? So we've got, we are really in the midst of a trade war. And the tariff issues, I think, are very much on policymakers' minds. Is this, are our tariff issues going to get resolved anytime soon? We've already had a postponement from March into possibly April, but even April isn't looking like we're going to necessarily have an end to the issues on tariffs. And there's also, this headwind coming from lower global demand, right? So it's not great when you have lower demand for U.S. goods and services coming from other countries, which are also experiencing a slowdown. So I think the Fed, the FOMC, they're keeping their eyes on what's happening worldwide as well.
Sarah, when we consider the yield curve, the 10-year got up to 3.2% or thereabouts, now back down at 2.6%. Do you think 3.2 will prove to be the peak for this cycle?
Hard to know indeed. We are living through really volatile times. And one of the features, I think, that we've seen since the end of December has been this notion that predictability is not one that's kind of the nature of the environment right now. There's quite a bit of unpredictability, and I think volatility in all measures is going to be something that we are going to continue to see.
So, I mean, the talk now is that this Fed is market dependent, that Powell finally, got some religion and realized that he was too hawkish after, the November meeting and stopped talking about rate hikes, started talking about patience, stopped talking about autopilot, started talking about flexibility. I'm wondering how market dependent they really are, Sarah. So if you were still a governor on that board, would you hike interest rates if you thought the outlook warranted, even if the market was pricing in none this year as it is?
Yeah, it's a great question because obviously the Fed's tools work through markets, right? So their tools are essentially interest rates and the size of their balance sheet. And so those are tools that work through markets. And yet, you have to remember that it isn't market dependency that the Fed is supposed to be focused on. They are supposed to be focused on the real economy, and in particular, two mandates, one having to do with maximum employment and the other having to do with price stability. So they've got to be looking through markets and looking to the, what's called the real economy in terms of making decisions. So I think that market dependency, certainly dependency at the cost of looking through to the real economy, is not a good posture to be in. And unfortunately, I think this president has pushed a little bit on making the Fed seem to want to yield to a notion of market dependency, and that has to be watched.
Fed's dependent on the markets. Markets are dependent on the Fed. Sarah Bloom Raskin, thank you.
There you go. Thank you.